This likely gets a hell of a lot worse before it gets better. My view, we are only in inning 4 or 5 here. This is not inning 9, and this isn't something that you just sweep under the rug and it just goes away magically. This is going to be systemic. Is this going to lead to a GFC type of crisis, or maybe just an economic contraction, maybe just a credit crisis that isn't a global financial crisis? Who knows? I mean, they say history doesn't repeat, it rhymes. In this case, it might be repeating. Hello, fellow Robo Capitals. Hope you're well. So, we have more news in private credit. It seems like every single day I'm doing a video on private credit, but there's reasons to. We have Deutsche Bank and Morgan Stanley now saying that they have direct issues involving what is effectively subprime lending, whether it's to a mortgage or whether it's to some some toxic sludge, whether it's to Tricolor or First Brands or some software company that's never ever going to make money. The net result is still the exact same. So let's dive into the details. And as always, let's try to combine all of the facts that we have, look at all of the data, and determine if this is going to be systemic. Is this going to lead to a GFC type of crisis, or maybe just an economic contraction, maybe just a credit crisis that isn't a global financial crisis? Who knows? The bottom line is, in my view, we are only in inning 4 or 5 here. This is not inning 9, and this isn't something that you just sweep under the rug and it just goes away magically. This likely gets a hell of a lot worse before it gets better. So let's dive into, where do we start, for heaven's sakes? Let's go over to Zero Hedge, and we're going to look at Deutsche Bank. So Deutsche Bank dumps, after they're talking about their share price, after flagging 30 billion in exposure to private credit. And like I've said in a lot of my videos recently, it's not just the $30 billion. That's just the tip of the iceberg, because you have to look at what this does to global liquidity in the monetary system. And liquidity is just basically or a proxy or a derivative of risk. So when you're looking at this $30 billion in exposure to private credit with Deutsche, just ask yourself a question. Does this increase perceived counterparty risk, or does it decrease perceived counterparty risk? And if it decreases it, then you have your answer. Liquidity has dried up, or liquidity is less than it otherwise would have been. Money is getting tighter. And in an economy that's debt-based, in a monetary system that's debt-based, when money gets tight, you got problems. And then it usually exacerbates the cycle and makes it even worse. All right, let's get to this article here. They say yet another canary in the ever-growing coal mine. No kidding. I mean, literally, it's like daily. It's like I'm doing the same video every single day. It's like Groundhog's Day with Bill Murray. Every day I wake up and it's the exact same headlines. Deutsche Bank's annual report flagged a significant $30 billion exposure to private credit, an asset that's grappling with redemptions. And I mean, if you didn't watch yesterday's video, it's JP Morgan, it's BlackRock, it's the new kids on the block, Cliffwater is what it was. And if you weren't paying attention to my other videos, it's also, was it MLF? It was some acronym. I forgot what it was, stood for, but it was a mortgage company in the UK that blew up. It's just, this is happening right and left. We're not even seeing smoke anymore. Now we're seeing the fire. And there is no one on the planet, no rational person, no reasonable person that can say now this is anything other than a crisis. And that is not hyperbole at all. Let's keep going here. Now, what I think is interesting is how they're blaming a lot of this on software companies and therefore blaming it on AI. Now, I think this is strategic. Is AI impacting these software companies, and are they, these loans to software companies, on the books of these private credit shadow lenders or banks? Yes, that is true. But I think it's also a very convenient excuse for a lot of these banks and a lot of these entities in the space where they can use AI and say, this is why we're firing all of these people. It's not because we're in trouble. It's not because there's anything you need to worry about. It's not because we're taking hits on our balance sheet. It's not because we're losing money. It's not because we're on the fast road to going bankrupt in some cases. It's simply because we're leveraging AI. So the fact that we're firing all these people, no, that's not a bad thing. Are you kidding me? That's a good thing. Go ahead. Make sure you don't sell our shares. Make sure you buy our company. Make sure you buy our shares on the open market there, because this is creating shareholder value. So then what they don't tell you is the real reason they're firing all those employees is because they're having big, big, big problems and they're losing money. They're hemorrhaging money in a lot of cases. Okay, let's keep going here. So they say slow motion train wreck. Most recently, excuse me, Morgan Stanley, Cliffwater, BlackRock, and by the way, JP Morgan as well. They're having all of these issues. It's funny too. I think I said this yesterday. The JP Morgan came out, or excuse me, Jamie Dimon came out and warned us about the cockroaches 2 or 3 months ago, and he looked prophetic. I mean, it's like, wow, this guy really knows his stuff. He can see into the future. Why did he know so much? Because he's one of the cockroaches. He's one of the cockroaches. That's why. Let's get back to this. So the report showed private credit portfolio increased. Let's see, in 2024. Okay, yeah, we got that. Tech sector, software. Okay, we got that. Looks like according to Bloomberg, according to Bloomberg, they're saying Deutsche Bank, they are not exposed to significant risks. What are they going to say? Like, let's go back to the GFC prior to Bear Stearns and Lehman Brothers blowing up. In fact, Lehman Brothers, they were saying there's no significant risk like 3 days before they went completely belly up. I mean, it's a script that they all have to say, because if they admitted that there were risks, then everyone would sell and it'd be a self-fulfilling prophecy. Then they definitely would go bust. It's just they're trying to kick the can down the road and just pray that some miracle happens and this turns around and the economy gets going and the labor market starts accelerating. It doesn't work that way. Okay, they're identifying the key risks, and you can see it in their share price because the market is sniffing this out. Right? I mean, look, you're going from here and you're just gapping down when they come out with this report, trying to calm everyone down, saying that they don't have any significant exposure to these risks, or however they're phrasing it. Yeah, the market isn't buying that. The market is not buying that. And by the way, I did a whiteboard video today looking at the financials, what they're doing today or what they've done in 2026. And I was looking at the XLF, specifically the ETF, and you see it going straight down. And then you go back to the GFC, and wouldn't you know it, it's going straight down. And this precedes the crisis, as you would expect. When you have a financial crisis, you would expect the share prices of those financial institutions to go down prior to the big bang, say. Which is exactly what they did. Exactly what they did. I love this meme. This is fantastic. So they've got 2008 oil approaching 150, subprime quietly imploding. Or you've got 2026 oil approaching 150, private credit quietly imploding. And then it's got, I forgot what this gal's name is. Fantastic, The Office, one of my favorite shows of all. Pam, of course. So then you got Pam here. It says, corporate needs you to find the differences between this picture and this picture. There is no difference. That's the punchline. There's no difference. It's I mean, they say history doesn't repeat, it rhymes. In this case, it might be repeating. Oh, but we're not done. Oh, but wait, there is more. Let's go over to the Wall Street Journal, and boom, Morgan Stanley. Like we said, it ain't just JP Morgan. It's not just BlackRock. It's not just Blackstone. It's not just Cliffhanger or Cliffwater. This isn't a cliffhanger because we know exactly how this movie ends. Let's get to this Wall Street Journal article. Morgan Stanley caps private credit fund redemptions. They're all doing it. They're all doing it. And do you think this makes investors less wary? Do you think this gives them confidence? I mean, put yourself in the position of being an investor in one of these private credit funds right now. I mean, you've got to be sprinting toward the exit, especially when these funds say, no, you can't have your money back. Tough. We need the money more than you do. It's like, remember Cyprus? It's like the bail-in when basically those banks said, oh, sorry, depositors, we need your money more than you do. It's like a similar thing here where they're saying, oh, we got all these illiquid assets that we can't sell, or we're really going to go. That's really a quick trip to the poorhouse, as Jim Rogers says. So therefore, we need your money more than you do. It's almost the same thing. If right now, let's say they've got 5% per quarter that they're willing to give, this 5% limit. Here's where they say it right here. And right now they've got a 10.9% withdrawal request or redemption request. What do you think it's going to be next quarter? You think it's going to be 10.9? Are you crazy? It's going to go to 20 or 30%. And then what do you do when you got a lot of heat on you? Do you just sit there and say, no, it's the 5% limit? Because then investors are going to be pissed. They're going to be demanding that you give them actual values for the toxic sludge on your balance sheet. And then you got to write it down from 100 cents to its real value, or you have to sell. And then you got price discovery. And now all of a sudden, all these things that you're carrying on your balance sheet at 100 cents go straight down to 10. In which case you're bust. Negative equity, you're tits up. This is how these things always play out. And by the way, the key ingredient, the key part of the story here is not that these private credit funds blow up. It's what does this do to liquidity? What does this do to the amount of money that is circulating in the domestic economy, in the global economy? Because that money circulating is like the oil in an engine. And if that money doesn't circulate, if there's no more oil in an engine, it seizes up. So just think of these banks, these financial institutions as the oil in an engine, and they're the ones that are circulating the oil, right? And if they stop circulating that oil, which is, what would you do? Would you keep lending? Of course not. So there's a high probability that they stop circulating the oil. Then what should we expect next? You should expect the engine, or in this case, the economy, to seize up. So Morgan Stanley shares fell 3.7%. I can't believe they only fell by that. I mean, this is not investment advice, but I'm personally strongly considering shorting these financials. Investors are, it's very asymmetric, right? Because if oil continues to go up, then you're going to have pressure on the overall stock market, therefore pressure on the financials. And if oil goes down, then everyone's going to take their focus away from the Middle East and back to the domestic economy, where you have a negative 92,000 payroll, non-farm payroll number, and you have private credit blowing up right, left, and center. And what do you think that's going to do? That's going to put even further downward pressure on the share prices of these financials. Again, this is not investing advice. I'm just sharing with you guys what I'm thinking through possibly for my own portfolio. So they say investors are spooked after recent collapses. You don't say. I'd be more than spooked. I'd be crapping my pants. At the end of January, the North Haven Private Income Fund was invested in debt of 312 mid-sized companies, which there's very little disclosure. It's extremely opaque. What type of companies are these? They seem to be diversified. No, where you look at 22% of them were in the software space, which is getting their butt handed to them by AI. So this is like a perfect storm where these companies that they're investing in are getting hit by the underlying fundamentals of the economy deteriorating, and they're getting hit by AI potentially eating their lunch. So then what does Morgan Stanley do? Well, here you go. Here's the New York Post. Wall Street executives blame Morgan Stanley's latest layoffs on AI. So you see what's happening. It goes back to what I was saying earlier. You see what's happening. And I'm not saying this is, I mean, I have no insider information here. I'm just trying to use some common sense. And I'm trying to put myself in the position of these executives. So let's just assume for a moment that they are in deep trouble when it comes to their balance sheet due to the private credit, we'll call it subprime, call it what it is, the subprime crisis 2.0. So let's say they're in hot water due to this. Are you going to come out and say that you've got to lay off thousands of people due to your balance sheet blowing up when you have a perfect excuse? You say, oh, no. We're laying off all of these people because we're leveraging the power of AI. Aha, there you go. So now the investors look at that and say, oh, my goodness gracious. Well, this is adding shareholder value. Buy. You see, it's the spin that they're putting on this. Now, my guess is that when we fast forward 6 months and look back on this, we'll be like, yeah, that Morgan Stanley press release about how they laid off thousands of people due to AI, that was not because of AI. Well, it might have been because of AI is taking all the business away from the software companies that they have exposure to, and that's blowing a hole in the balance sheet. Maybe that's it. But the real reason they're laying off these workers is not because they're increasing productivity and they're increasing efficiencies. It's because they are in hot water. They are really struggling. They're losing money, and they see this on the brink of tipping over, just like we saw in the summer of 2008. And, you know, these people in the financial economy, these financial institutions, they're not stupid. They understand how the game is played. And they understand that if you have a liquidity crisis, which is caused by a lack of circulation of dollars, which is caused by perceived counterparty risk skyrocketing, which is what we see right now, that means entities go bust. That's what happens in these credit cycles. You've got the boom, now we're on the bust part of the cycle here. And so they're trying to kick the can down the road, as that's their only game plan. That's the only thing they can do. So again, the point here is I would not be surprised if they're just using an AI as a narrative to further kick that can down the road and try to avoid what I think is likely the inevitable. Not that they completely go bust, but that we haven't seen the worst of it. I think that's really what I'm trying to say. We're not in inning 9. We're in inning maybe 4 or 5. All right, guys. Now, if you want to find out what I'm doing with my own portfolio, insider intel as to how the pros like Chris McIntosh, Patrick Srezna, Brent Johnson are playing this, and how we're hopefully setting up our portfolio so we not just survive, but we actually thrive during these crazy times. You can check out Rebel Capital's Pro. That's I don't want to call it a newsletter because it's way better than a newsletter. It's an online investment community that I have with research from Lynn Alden, Chris McIntosh. You've got live streams with people like me, yours truly, where you can ask me questions, but more importantly, live streams where you can ask direct questions. You guys like Brent Johnson, Patrick Srezna, Chris McIntosh, just to name a few. And you can go back and forth with your fellow rebel capitalists and really think this stuff through and set yourself up to where you're anti-fragile, let's say, in an environment that is extremely fragile. And that's not even considering what's happening in the Middle East. So if you want to check out more about Rebel Capitalist Pro, Josh put a link in the chat and in the description below. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism, and make sure you tune in tomorrow where you'll likely hear a repeat of this exact same video.
Join the Rebel Capitalist Pro community. Visit rebelcapitalistpro.com.